welcome to BloombergQuint. We've been coming to you periodically with updates on how the Indian debt markets are doing. Since our last update, the markets, at least on the government bond side, are looking far calmer. This morning, we're trading just a little above the 6% mark on the benchmark 10-year bond. State government yields, which spiked up in the first auction of the Fiscal, have calmed off, but there is a perception that the corporate bond markets are still very nervous. Lots of risk aversion in that part of the segment. Joining us to talk about all aspects of the debt market right now and what the RBI has done right and what it still needs to do is Jayesh Mehta, Country Treasurer at Bank of America, veteran of the Indian debt markets. Jayesh, sir, thank you so much for taking time to speak to us on BloombergQuint. I'm going to, sir, tackle this segment by segment, and I'll start by getting your views on the government bond market. Interestingly, today, yields have come off, perhaps taking a signal from the government's hike in duties on petrol products, which may suggest that the government is being very fiscally conservative even now. There's no second large package. And on the other hand, they seem to be using taxes to bridge the gap. Is that what's helping keep government bond yields in check, sir?
Yeah, so I think the market kind of is estimating with this hike, it will give the government actually something like almost like 125,000 crores surplus, and therefore the burden on extra borrowing goes down. That's the way the market is looking at it. But overall, I think we still need to see the whole big picture as to how much excess. And yes, people are fairly confident that RBI will support the government any excess borrowing program. But at least whatever excess X number, nobody knows as of right now. But at least this part will kind of get reduced to that extent. So market's kind of happy, taking it very, very positively, particularly only from the government bond market side of.
What is your sense, sir? How will this play out? I think, there was a Bloomberg report suggesting that even last year's fiscal deficit ended at 4.4% compared to the 3.8. This year's number, nobody has an idea on what, should be used as a benchmark. But is it your sense that whatever is sort of the incremental borrowing over, say, what was budgeted in February, will somehow be absorbed by the RBI, either through open market operations or direct monetization?
I'm fairly confident about it, and that's the right thing to do. Because if you really look at it, we need to split out two things. One is the fiscal, the financial side, bond market, and other stuff, and then the real economy. And the problem is with real economy, and that's need to get sorted out. And that's why people need to cut the clutter, get into the right mode. Honestly speaking, from RBI's perspective, also whatever we heard governor till now, they're all prepared, but till the actual number comes in, and even for government to give out actual number of excess borrowing, they need to do their legwork. We don't know how far, like even this 2 week extension, the math would have changed. So rather than announcing a number, they have gone ahead with the exact budgeted numbers, and as and when they firm up, they finalize it, and I'm sure they would be in consultation with RBI, and RBI will support them the extra borrowing, because standalone getting the entire excess borrowing in the market is not going to help, right? And we need to support the economy too. And I don't think people are making too much of hue and cry, like even if it is 4 or 5 lakh crore extra. I'm just saying on a hypothetical side, I think it all can be managed. And something one has to look at it, like, people talk of all kind of numbers. Somebody talked about 8 lakh crores and all that stuff. All that is fine. But at the end of the day, government has to spend, implement it. It's implementation also. We have now almost like 11 months left, implementation of that, not even 11 months, 10 months left, right? Implementation of that spending has also to be done it's not easy to just spend, right? It has to be planned, and then it has to be spent, and therefore the actual number will come as and when it comes.
What would you prefer, Jayesh? And I'm asking you for your preference because you've seen this debt market through various phases, perhaps even during the time when we used to do automatic monetization. What would be preferable to the market, to your mind? OMOs, large-scale OMOs, or some sort of direct monetization? And how do you expect the government, the 10-year, the benchmark market to respond in these scenarios potentially?
So either way is fine. Actually speaking, yeah, one can say in 2009 we actually didn't do direct purchase. RBI didn't directly purchase from government, and it actually went ahead and purchased every alternate week in the secondary market. That's also perfectly fine as long as there is comfort which is there, which was given in 2009. That okay, fine. Even though we are not buying in primary, is as good as buying as primary because every alternate week they would come out and buy back the same stock which has been issued. And therefore, yeah, the market players will make some arbitrage, but that's a very small amount, small cost to do it. One has to look at it technically. If they are able to buy directly, that's also fine. By doing it through market, it kind of, people feel that it kind of gives you market sense, market price, but it's also that market price is valid because RBI is buying after 15 days or so. So from that perspective, I would say both are equally fine. There is no issue whatsoever. And I think one has to also not worry about monetization because at the end of the day, we are looking at what would monetization do in worst case scenario, right? Fiscal deficit, also what would it do? It will kind of aid your inflation, but at this juncture, we don't need to worry about inflation. 2008-9 was very different. Economy was solid. There was no problem with economy. And then you widen your fiscal deficit, and then you supported that fiscal deficit at a lower rate. That is a different story. Here right now, there is serious problem.
So, sir, do you think, just to wrap up the government bond side before I go to the other segments, what is your sense on how yields will move? Will we come back to, say, a repo to 10-year spread of about 100 odd basis points, which should then bring the 10-year to below 6? We're flirting with that 6% mark today.
No, I'm looking at, eventually maybe I'll jump the gun a little bit, right? Like everybody is talking about supporting credit, supporting corporate bonds, supporting every growth, right? But the way the yield curve gets, the credit curve gets built is your risk-free becomes very unattractive. So it has to go to somewhere around 5. We are still almost 100 basis point over than where it should be going. So from that perspective, it should go at least to 5. Maybe state loan should go to maybe 6. And that's when the risk appetite, people will start taking other risk, and the risk appetite starts building up. And that's how it happens globally, and that's how it happens typically in a credit market. So your spreads are so wide, and then people start getting into it. People start getting comfortable into the wider spread. The spreads start getting tightened, and as the economy improves, it gets tightened further. So from that perspective, we need to go much lower from the current level.
Okay. Sir, what's interesting is what's happening on the state bond side as well. Why is the spread over central government GSECs for state government bonds so wide? Practically speaking, there is no risk of default there, and you're getting a higher rate. Why are banks and treasuries not rushing in to buy state government bonds?
To be fair, I think last week or maybe 15 days, 20 days back, that would have been the correct statement to make. Right now, if you really look at it, like 10-year state loan is almost like 680, 675. There's hardly 70 basis point differential, which has been there, which has widened from, say, historically 40, 50 to last few years. It has widened because state borrowing has gone up. And again, the predictability of the state borrowing, unlike government, is kind of, government comes out with a calendar, total borrowing program. Here, that predictability is missing. I think what happened in earlier last month or something, people actually, there was a confusion that they may borrow 50% in 1 month, and there was clarification 50% in 9 months and stuff like that. So people were expecting, because of the lockdown, the state would need more money and therefore borrow upfront everything. I think that SDF facility for state, I think that's a good move from RBI.
Okay, but you don't see any need for the RBI, or maybe later in the year, do you think there will be a need for the RBI to support state government borrowings as well? I believe they have never actually done open market operations in state government bonds. Is that correct, sir? And do you think we may have to at least consider?
So they haven't done ever, right? So I think you see, and that's where other day I talked to you, and I really feel bad, like when people straight away start saying, okay, RBI should buying corporate bond, RBI should start buying NBFC papers and stuff like that. I think there is a sequencing, right? You have Government of India, followed by if the things does not get controlled, and then there is some more help required. If then there will be state loans. There is also another way to do about the state loan, as in your interview, Rakesh Mohan said, maybe government can borrow and distribute to state, but otherwise they can anyway support states. So that's the second thing. But till now, RBI has never done an OMO on state government bonds. But that's something one can explore. I'm just talking sequencing wise, right? And then even if that is not enough, the sequencing wise would come bank series. In spite of surplus liquidity, some banks are still struggling with liquidity. So therefore, the bank series would come third, and then your PSU and corporate bonds, and then your NBFC. So that's how the intervention, if required. But I don't think we need to go that back. I think this is a real economy issue, and therefore one has to work on the real economy. They should make their plan rather than worrying about whether they can afford it or not. What is that they can spend, what the government can spend, they should make their plan. I think I'm quite confident RBI can manage whatever requirement there.
So you're indicating, Jayesh sir, that you are not a believer of this clamor that RBI should start accepting corporate bonds as collateral. I think pretty much everyone is sort of hoping and saying that the RBI needs to do that. You don't agree?
As I said, it comes fourth on my list, right? So, as collateral, right, today TLTRO1, right? That's been fantastic thing given to the bank. It's giving them free spread. They removed the prudential norms of single borrower limits. They removed mark to market. What else? It's almost like a platter being given to them, and therefore, at least on the higher rated credit. On the lower rated credit, there is challenge. And if you think a bank or an NBFC or an individual, right, cannot buy, do you really want RBI to buy that? I don't think that's RBI job. Then if it is any credit guarantee has to be given, that should be the sovereign should be doing it, and not RBI, giving credit guarantee kind of support.
What is the state on the corporate bond side, sir, in terms of volumes, available liquidity, interest in purchases? Is the market more and more concentrated only in the AAA or the PSU bond side, sir? And hence there is a large swath of companies which were in the bond market which are no longer being able to access it?
Very true. Good you asked me that question. So, if you really look at it, we have been clamoring about, corporate bond market, and we still want to straight away, whenever we talk about corporate bond market, we talk about, lower credit. I think world over, if you really look at it, is the high grade which trades actively. In terms of course, straight away people start comparing ourselves with US. No, there is a lot of steps in between us and US, right? So we have to compare ourselves with other emerging market. And when we compare ourselves with other emerging market, our corporate bonds, when I say liquid, high-grade corporate bonds, in terms of issuance, in terms of turnover to the outstanding, in terms of bid-offer spread, it's I would say ranked among the top 3, 4 in the world. So I don't think there is a problem there. Yes, there is a structural issue, which I will talk in a couple of minutes. There is a structural issue as to why we don't have enough corporate bond market. But that is still not a challenge. And I think as you go down the credit curve, there is always a credit risk associated with it. And therefore, you need that kind of funds, that kind of money, that kind of risk appetite for that credit risk, which unfortunately we don't have it. Like if you really look at, it's a little bit got developed, but I think it's still not there. In India, people are either in equity or in like high grade debt. So there's nothing in between. over last few years, people have started going into some high yield thing. But there again, the problem is, when they go into high yield, which is kind of private debt, one can say, I'm not saying it is private debt, but kind of private debt, lower rated, and that's where they want the same safety as AAA. It doesn't work that way. So there are risks associated. It's a risk return premium chart, and therefore one has to follow that. Unfortunately, whenever that sort of things happens, like today, we talk about a lot of this illiquidity which came in last month or last 20 days back, 15 days back. I think one has to classify debt. When you say debt market or a bond market, typically it is associated with liquid bond market. When you go high yield, and some of these high yields were actually loan converted into bonds, it's more like a private debt. Coincidentally, we were the pioneers to do that in 2005-6. We actually started that market, but it's a very different risk profile. It's just like the way I would say some of them, I'm not saying all, some of them, as you go lower the credit curve, it's like the private debt is more like private equity. You can't provide liquidity just like any listed or privately placed bond. So I think that's the challenge. And coming to second, some of the bonds liquidity which went off recently, because if you look at the issuers, our banks were very aggressive. So typically we didn't have a lot of private sector corporate high grade issuing bonds. It was mostly PSUs and some private sector, but PSUs and NBFCs. Now, we are actually lucky. We actually got a big speed breaker in September 18 when there was some disruption among some NBFCs and stuff like that, which took 2-3 months, 4-5 months, and then it got resolved. It kind of stabilized, where people distinguish between good NBFC credit and risky NBFC credit, and that's where. So even today, if you look at good NBFC credit, they have absolutely no problem raising money. They have absolutely no problem.
Okay. So you then don't see any reason for the RBI to do anything more on that segment beyond what they have done. So they've already opened that window for mutual funds, although not much of it is used. At least until yesterday, it was only about 2,430 odd crore based on the RBI data somewhere there that had been used up. You don't see any reason for the RBI to need to intervene on the corporate debt side right now. Maybe announce another LTRO without sort of the micro conditions linked to the LTRO 2.0. You think they can at least do another LTRO 1 kind of structure, sir?
LTRO 1 kind of a structure was good. Yes, that's where, even in this one, if you look at it, just touching back on corporate bond with the mutual fund situation, the financing side, one of the things, just not financing, I think just like LTRO, they also give flexibility of buying bonds from mutual fund. That was a good one. But just for your information, like, today's market, there are some mutual funds who are actually buying bonds, right? So it's just when you have everything together, and when there is sudden news, people are wanting to know what is more news, and therefore people are going to bid up their, their ask would be going higher and higher, right? So from that perspective, in fact, some bonds which got traded in last fortnight are actually trading 2 points below that level. And actually some of the mutual funds are actually buying it. So it's not across a mutual fund problem. So there again, in debt fund, we need to classify, high grade bond fund and structured credit kind of bond fund. They're two different ball game altogether.
Okay, understood. So I want to shift topic to a little bit of this liquidity debate. We are seeing very large sort of balances being parked at reverse repo, but there is this debate about what that is signaling. Just the fact that the RBI, that banks are sitting on excess reserves, which they have to park with the RBI, or is there a link between that and the risk aversion in the system or not? I want your view, because I think everybody has a different view on how this reverse repo, large sort of parking of funds should be interpreted.
So there are two parts to it, right? So one part is, as we all know, last 4 years, and that's why we had a lot of shift happening to NBFCs. Banks were not lending, there was CVC fear, various fears, right? So banks were not really aggressively going out and lending. Even with, and of course, if you look at it, liquidity was kept tight earlier. It's only in last 1 year or so, maybe October 18 onwards, we started infusing liquidity, and comfortable liquidity started coming only post March 19. But when the liquidity started coming in, I think banks were still shy. Nobody wants to take a risk. What happens in the aftermath if there is a default, if there is a stuff? There was risk aversion among the bank side. Naturally, some enclave, I would say, is like all documentation may not be there, but you are okay to, earlier you were okay to lend with some crucial main documentation being there. But now everybody wants everything completely done. There are various issues on that side, but so I won't go and touch upon the lending side of it. But not buying government bond, not buying state loans is really challenging, because giving back money at 375. Earlier, they were not even buying corporate bonds. Now with LTRO, they are actually buying corporate bonds, because then here again, people start talking about mark-to-market risk, or they have a mark-to-market risk. Like, of course, now the carry has gone a little lower, but at 4% carry, there's no mark-to-market risk. Really, if you have 4% carry for a year and a half, your mark-to-market risk gets reduced dramatically. So from that perspective, one should not be worried about it. But yeah, they are moving it slowly. Banks are buying it. Theoretically, one can say with 8 lakh crore, assuming 6 lakh crore more, so maybe SLR to deposit, which is at around 28%, normally is 26, 27%. It should be at 32, 33%. But also one has to look at it that there will be issuance coming in next 10 months, and therefore right now to go ahead and buy everything, and then when you have the issuance coming in, that's where the challenge is. So I think we need to, once the government decides with so much of liquidity sloshing in, we need to upfront some of the issuance, and therefore we need to give a clarity that this is the issuance, overall issuance, and then maybe once you say, okay, fine, let's do something upfront, supported, of course, along with the RBI.
Okay. Sir, we haven't gotten an announcement yet, but everybody is expecting that a standing deposit facility will finally be operationalized, because the RBI may run out of bonds to give under the reverse repo window. Very confusing on how that will play out, right? How will they set the rate? Will it be linked to repo? If it's not linked to repo, how will the market interpret it? Will it be the new floor on rates or not? Any thoughts on how this SDF should be done if we have to do it?
So I think you see that was that the approval got done in the demo time, and that's the time the similar fear was there that we will run out of the security, and therefore, how do we borrow? So that was one part. Of course, simultaneously there is a clamor that to make reverse repo more unattractive and therefore cap it and bring the SDF maybe 0.5% lower or something lower than the reverse repo rate. So of course the mechanics I also really don't know. I would be completely indifferent whether you keep it the same rate. I think the purpose for SDF was security being not there, and therefore you get more securities to it. And there are talk, some people said, okay, we need to cap reverse repo and all that. No, it doesn't work, because at the end of the day, system surplus has to get out of the system. At the most, one can also further reduce reverse repo. Like I'll tell you, we were at 3/4 in 2008, and there was no real economy problem. We have a real economy problem. We don't have inflation worry. The inflation was higher in 2008, yet we were at 3/4. So I don't see why we cannot go further down on reverse repo, and that's what we should be focusing more on.
Okay. Jayesh, I have time for one last question, and it's telling that this is my last question and not my first question, and that's on the currency side, sir. That has actually been a heartening factor that this time around, while we've seen depreciation, as we should along with the rest of the world, we haven't seen any sort of unruly behavior on the currency. We haven't seen a rush to cover positions, perhaps suggesting that the hedge positions are higher this time around than in, say, previous crises. What is your sense on what's playing out on the currency side, sir?
So typically, whenever we have, you see, right now we are getting weakened because of dollar strengthening, along with everybody else, we are getting weakening, and there is of course outflow, right? And typically, when India is facing outflow, oil prices also are very high. I think that is playing a big thing, right? We have oil prices which is very supportive. That's our largest import, and that's being supportive. That will play the thing, and as and when, and with the oil price being the same lower, I think we should not be outlier to other currencies as compared to the dollar, and therefore, we should be okay without it. But I would say I would just add one more thing. And in terms of, you see, earlier when we had, whenever we had typically, outflows coming in, and the oil price would go up by $10 or something, which is like $10 billion cost on exchequer, and therefore we would depreciate a little bit more than the others. And also, of course, another factor is debt. This time the foreigners didn't have too much of debt, and I think that's where again I want to make a point. Our market being liquid, again I underline our market being liquid, we many a time suffer when people want to reduce their Asia position amongst the emerging market. We get hit because the other markets really get shut. So even if you look at mid-March, there were emerging market in Asia, even on their government bonds, there were no bids and offer for, there were no type 2A for maybe 5 days in a row. So from that perspective, we have a good market, and that's what we should really push forward going forward.
All right, Jayesh, I'll have to leave it at that, running out of time. But thank you so much. That was a great conversation spanning government bonds, state government bonds, and corporate debt. Jayesh Mehta of Bank of America, thanks so much for watching Bloomberg.